$4,800. Actually, let's be precise here because every single cent counts when you're talking about history. $4,819.75.
It's a staggering number. It really is. It feels less like a stock ticker and more like a scoreboard for a game we didn't even realize we were playing.
That is the price for 1 ounce of gold. As of this morning, Tuesday, January 20th, 2026, it didn't just break the psychological barrier of 4,800. It smashed right through it.
Yep.
And if you're just glancing at the headlines, you might think, okay, inflation's bad, business as usual. But the stack reports we have in front of us today, from Gen10 Data, Market Reference, TD Securities, and UBP, they suggest this is anything but.
No, business as usual left the building a long, long time ago. What we're looking at is a market that's just fundamentally scared.
Right.
And what's so fascinating and kind of confusing is that while gold is skyrocketing, its usual partner in crime silver is telling a completely different story. It's actually flashing these bright red warning lights.
And that's the mystery we need to solve today. I mean, usually these two move in tandem. Gold's the big brother, silver's the volatile little brother.
Right.
But right now, they're practically at war with each other. So we're looking at these reports today to answer one big question. In the middle of this historic gold rush, why are experts screaming danger when it comes to silver?
And to answer that, we have to look at the backdrop. Because this isn't happening in a vacuum. You just can't understand these price movements without looking at the chaos that's unfolding.
You mean in Greenland?
In Greenland, the meltdown of the Japanese bond market and that absolute diplomatic brawl that's happening at Davos right now.
It really does feel like the world is coming apart at the seams a little bit.
It certainly feels fragile.
Yeah.
And that chaos is exactly what we need to unpack to understand what's happening in your portfolio right now.
Okay, so let's start with the big one, the headline grabber, the gold rocket. We mentioned that price, $48,1975, an all-time high. It just keeps hitting new records. Now, normally we just say inflation veg and kind of move on, but the sources are pointing to something much more specific than just the CPI.
It's so much more than inflation. It's fear. And a very specific kind of geopolitical fear. We have to talk about what is happening with Greenland.
All right, Greenland.
Yeah.
This story has been bubbling for a while, but it just feels like it boiled over. The source material says the U.S. President, Trump, is showing absolutely no signs of backing down.
No, not at all. And the rhetoric has just escalated severely. The Prime Minister of Greenland, he explicitly told citizens to prepare for a possible military invasion.
Wow.
Now, he did qualify that. He said it's unlikely. But just the fact that a head of government is using those words, military invasion, that sends shivers through the markets.
I mean, can you imagine hearing that as a citizen? But this isn't just a local issue, is it? It's dragged Europe right into the ring.
Oh, completely. And this is where that trade rift comes in. You have French President Macron coming out swinging. He's attacking U.S. trade policy directly.
And his choice of words was something else.
It was fascinating. He warned that Europe needs more sovereignty to avoid, and this is a direct quote, vassalization and bloody politics.
Vassalization. I mean, that's a medieval term. That's not something you hear in modern trade talks. That implies what? A feudal system, a master and a servant.
It's a very strong word. It implies complete subservience. And it just highlights how fractured the Western alliance has become. You have traditional allies effectively threatening each other.
So investors don't know who's friends with whom anymore.
Exactly. And then you have Mark Carney, the Canadian Prime Minister, dropping an absolute bombshell at Davos.
Oh, this quote stood out to me. He said the rules-based international order is effectively dead.
Dead, not strained, not evolving, dead. When you have world leaders at Davos just openly admitting that the rules no longer apply, that the very structure that has held the global economy together is gone.
Investors panic.
They panic. They stop looking for growth, and they start looking for safety.
And that's gold.
That is gold. Gold doesn't care about treaties. It doesn't care about trade wars. It's the ultimate hedge against the death of order. It's the only asset that isn't someone else's liability.
But there's another layer to this, right? It's not just politicians yelling at each other. There's a financial machine breaking down in the background. We have to talk about Japan.
Yes. The Japanese sovereign debt market. This is the financial catalyst. We are literally watching a collapse in Japanese government bonds.
Okay, so for anyone listening who maybe doesn't trade bonds every day, break this down. Why does a crash in Japanese bonds matter to the price of gold in New York or London?
Because Japan has always been this pillar of stability. massive anchor for the whole system. When that market cracks, it signals a loss of faith in government debt globally.
And the sources call it the debasement trade.
The debasement.
So what does that actually mean for the average investor?
Well, essentially, investors are looking at major economies, and not just Japan, but the ripple effects everywhere. And they're saying, I don't trust your currency, and I don't trust your government's promise to pay me back.
That promise being the bond.
The bond itself. And if they don't trust the bond, they flee the currency. They are running away from paper money.
To the shiny yellow metal.
Precisely. Daniel Gali, he's the senior commodity strategist at TD Securities. He put it really well in the report. He said, this situation in Japan is sparking fear of a market-dominant debasement globally.
Market-dominant? That sounds terrifying. It sounds like the market is taking the wheel away from the central banks.
That's exactly the fear. But here's the nuance. Gali notes that gold's rally is entirely about trust. And he has this great line. He says, currently trust is bent, but not broken.
Bent, but not broken.
Right, meaning the system is straining, it's warping. That's why gold is at 4,800. But his point is, if that trust actually breaks,
if the twig snaps.
If it snaps, the momentum we're seeing now is just the beginning. It'll go even longer and higher.
So gold is the report card on global trust, and right now we are failing the class.
That's a perfect way to put it. We're getting an F in stability, so gold gets an A in price.
Okay, that explains the gold rocket. It makes perfect sense. World is scary. Buy gold. But here is where it gets really interesting and confusing. Silver. If the world is ending, shouldn't silver be coming along for the ride?
You would think so. I mean, historically, they move together. They're the dynamic duo of precious metals.
Look at the data.
Look at the data. While gold is hitting 48.19, spot silver actually took a nosedive in the short term. It fell below $94 an ounce.
Below 94. Now, to anyone who hasn't looked at silver in 5 years, $94 sounds high, but relatively speaking, it's lagging. And the sources are throwing around this label for silver right now.
Danger. Yes. This comes from Peter Kinsella. He's the global head of FX at UBP. And he is incredibly bearish on silver right now. He actually said that buying silver at current levels is very brave.
And in finance, brave is usually a polite way of saying, you're about to lose your shirt.
Or crazy. He actually used the word crazy, too.
Wow. Okay, so why? Why is silver the villain in this story? Or maybe the victim?
Well, first you have to look at the run-up. Silver has already jumped 50 to 60% in just the last 2 or 3 months. So it's already had this massive rally. It's expensive.
Okay.
But the real killer here is volatility.
The measure of how much the price swings up and down?
Correct. Think of it like a boat. Gold is a large ship in rough seas. It moves, but it's somewhat steady. Silver right now, it's a canoe in a hurricane. For silver, the implied volatility is at 65%.
65.
And Kinsella warns it could hit 70%. That is just astronomical for a precious metal. It means the price swings are violent. It makes it an incredibly risky asset to hold.
So if you buy gold, you're buying insurance.
But if you buy silver right now, you're buying a lottery ticket in the middle of a storm.
That's a vivid image. But there was some specific news last week that triggered this drop, wasn't there? Something about tariffs.
Yes, this was a big deal, according to the analysis. The United States announced it will not impose tariffs on silver.
Wait, hold on. Usually no tariffs is good news, right? It means trade flows freely. Why would that hurt the price?
It's counterintuitive, I know. But here's the logic Kinsella lays out. Because there was a fear that tariffs were coming, inventory had been building up in the U.S.
Ah, so people were stockpiling it, panic buying before the deadline.
Exactly. But now that the threat is gone, that inventory is going to be released. The floodgates open.
So supply goes up.
U.S. inventories increased significantly. Now, those stockpiles might flow elsewhere. That increases supply in the market. It lowers global lease rates. And importantly, it busts a myth.
And what myth is that?
The myth that there's a severe shortage of physical silver. You hear this all the time from the silver bugs. There's no silver left. Buy now. Kinsella says when you do the math on these inventory shifts.
That argument may not hold water.
Exactly. So the scarcity story is evaporating just as the volatility is spiking. It's a really bad combination.
And then there's the valuation problem.
The math just doesn't work.
Okay, let's talk about the math because I saw some numbers about the gold-silver ratio in the notes. Break that down for us.
The gold-silver ratio is just how many ounces of silver it takes to buy 1 ounce of gold. Historically, the average is around 65.
65, okay.
So for silver to really skyrocket from its current price, To make it worth all this risk, you'd have to assume that ratio drops way down to, say, 30 or 40.
And is that likely?
According to our expert, expecting it to drop that low is, and I'm quoting here, stupid.
He did not mince words.
He really didn't. He says it's statistically stupid relative to history. And here's the kicker. Even if gold keeps rallying, let's say it hits $5,000 by year end.
Which is a huge number.
Huge number. But if the gold-silver ratio just normalizes, if it just goes back to that average of 65, silver prices might stay exactly where they are.
So gold could go up another $200, and silver investors could see zero gains.
Precisely. You have limited upside and massive volatility risk. That's why he calls it a trap. You're basically betting against history and math while holding a grenade of volatility.
Okay, let's zoom out. We've got the gold rocket, the silver trap, but there's a bigger theme connecting all of this. Greenland, Japan, the metals, the sources call it a new era.
Yes, the era of resource nationalism.
Resource nationalism. It sounds like something from a history book, but it's happening right now. What does that actually mean?
It is the defining theme of 2026. It means countries are prioritizing holding actual physical resources over holding other countries' money.
It's not about currencies anymore.
It's not. Look at what's happening. We mentioned Greenland. That's a fight over physical territory. The sources also mentioned the president of Venezuela being caught recently, another resource-rich nation in turmoil.
Right.
The common thread is that major powers are no longer competing just for market share or GDP growth. They are competing for physical things: land, islands, oil, minerals.
It's like a global game of risk.
It is. And Kinsella makes a brilliant point here. In a world of great power competition for physical stuff, holding currencies is not the best play.
Because currencies are just paper promises from governments you no longer trust.
Exactly. Currencies are based on faith in treaties. We just established that the treaties are dead and the faith is bent. So the best play is investing in the assets themselves. But, and this is the crucial but, you have to pick the right asset.
And that brings us right back to why gold wins in this specific scenario.
Yes. This geopolitical theme, the fighting over borders and sovereignty, it favors gold specifically. Gold is the historic currency of conflict. It's what you hold when you don't know who will be in charge of the bank tomorrow.
Whereas silver, with all its industrial uses, it's tied to manufacturing.
It's tied to the economic cycle. If trade wars escalate, remember Macron's warning about bloody politics, manufacturing might slow down. If factories aren't building solar panels or electronics, silver demand drops.
But gold?
Gold is a pure store of value. Kinsella notes that even at these all-time highs, gold has a clear upside logic because of resource nationalism. The theme can change instantly, but as long as nations are grabbing land, gold is the hedge.
It's fascinating how it all connects. The Prime Minister of Greenland warning about an invasion is directly pumping the price of the gold coin in your safe.
It is all connected. The death of the rules-based order isn't just a political talking point. It is a market reality. And it changes how you value everything.
It really reframes how we should be looking at safety.
It does. In the old world, U.S. treasuries were safe. In this new world, physical assets are safe.
So let's try to recap this for everyone listening, trying to digest all this chaos. We have a world where the rules-based order is, quote, effectively dead, according to Prime Minister Carney.
And where Europe, led by Macron, is openly fearing vassalization. The old alliances are fractured.
We have Japan's bond market collapsing, shaking the very foundation of trust in sovereign debt.
Which is driving that debasement trade. Everyone is running for the exit on fiat currency.
And the result is gold at $4,800. It's a symptom of that broken trust.
While silver, despite all the hype, is looking more and more like a volatility trap. The no-tariff news has changed the inventory outlook, and the historical ratios suggest it's just overpriced.
It's a brave buy, to put it politely.
Very politely.
So the takeaway seems to be, don't just follow the crowd into precious metals as a blanket category. You have to understand the specific driver. Gold is the fear trade. Silver is the volatility trade.
Exactly. In an era of resource nationalism, you want the asset that sovereign nations hoard when they don't trust each other.
Yeah.
And that's gold.
It really makes you think about the fragility of it all. I keep going back to that quote from Daniel Gali at TD Securities.
About trust.
Yeah, that trust is bent, but not broken. It's such a haunting image.
It really is. It implies we're living on borrowed time, or at least stretched time.
And that leads me to the big question I want to leave our listeners with today. We are staring at gold at $48.19. That is the price of trust being bent.
Right.
So, What does the world look like, and what is the price of gold on the day that trust finally snaps? If this is the before picture, I'm not sure I want to see the after.
It's a sobering thought. If the bond markets fully break, or if those unlikely military invasions become real, 4,800 might look cheap in retrospect.
A terrifying thought, but one we have to consider.
Absolutely.
We'll leave you to mull that over. Stay safe in these volatile markets, everyone.
And do your research.
We'll see you on the next Deep Dive.